Hello and welcome to the third episode of the Digital Dividend, a monthly intake on the most prominent news, trends and features surrounding fintech, digital finance and the platform economy. In today's episode, we welcome Federico Travella, founder and executive chairman of Novicap, Matt Kus, head of origination of developed markets at Fasanara Capital, and the CEO of Fasanara Capital, Francesco Filia. Please note that the information and opinions expressed in this podcast are for general informational purposes, and of no information or content provided on the podcast should be considered as a recommendation to buy, sell, or hold any security or investment. Any reliance on the information or opinions expressed in the podcast is at listeners' own risk. The hosts of the podcast may have an investment in some of the companies discussed, and such investments may create a conflict of interest. However, the hosts and guests have voluntarily agreed to appear on this podcast and have not received any compensation or payment for doing so.
So, hello everybody, I'm Francesco from Fasanara Capital. Welcome to the new edition of our Digital Dividend podcast. Today I'm joined by Matt Kus, who is our head of origination for developed markets. And our special guest is Federico Travella, CEO and founder of Novicap. Novicap is a digital lending platform funding invoices in Spain. It is a long-standing relationship of ours, a core partner for Fasanara. It is a partner that led us into more than 1.5 billion of volumes, more than 200,000 invoices traded, and more than 2,500 sellers, SMEs, selling invoices to Fasanara through the platform of Federico. We've been running since 2017 between Fasanara and Novicap, and Novicap started in 2015. So Federico, thank you for being with us. We'd like to start by asking you about Novicap, how you started, and how the idea of Novicap came about, what you were doing before, and how you ended up here.
First of all, thank you for having me. I think it's exciting to look back on indeed a long-standing relationship we've built up between our respective organizations, and a successful one that it indeed is, and perhaps reflect on some of the learnings along the way. My story started in lending not too long ago. My background, I'm a scientist. I'm a marine geologist, so arguably has nothing to do with lending. And through let's say a pivot, moving into technology businesses at the end of 2011, I joined Rocket Internet, which is a global venture builder, and we had the chance to build e-commerce businesses across the globe. And so one of those businesses called Lazada, where I was part of the management team in Southeast Asia, based out of Singapore, became one of the most successful portfolio businesses under the Rocket Internet umbrella. And we were a general e-commerce play, helping small businesses, merchants, sell products online. And so that is really the e-commerce business we built out there. And became very successful. We went to, I think, about 3,500 people in 3 years' time. Business eventually got acquired by Alibaba, the Chinese e-commerce giant. And so there I firsthand learned some of the struggles that small, medium businesses go through when it comes to working capital finance. Naturally, we were always trying to pay those businesses as late as possible, and this created a significant working capital issue on their side. And so as a buyer or as a platform, we start to pay more attention to working capital finance on the supplier, on the SME side. And long story short, throughout that experience, I learned how banks try to solve this issue, and especially some of the outdated technology they try to put to work in that regard. And via we got introduced to a number of banks. I learned about their technology. I learned what didn't work, what did work, and eventually decided that my next business will be in fintech. I moved to London. I joined a program called Barclays Rise, powered by Techstars, which gave me first-hand access to the working capital finance teams of Barclays, learning some of the inefficiencies again that the bank has or cannot solve. And that's when I started build Novicap around that. And so the original thesis has been to provide digital factoring to small, medium businesses. And as we all know, this is very much this is European economy. SMEs are powering Europe, are creating jobs, are driving growth in Europe, and these are also most affected by long-dated invoices, especially if they're corporate or government buyers.
Very interesting, and like it's also very core to Fasanara, the attention to SME, the real economy. It's so great as a capital allocator to be able to do something purposeful with your capital.
Yeah.
And there is no better place than the real economy. There is no better place than SMEs within the real economy, because that's the core of it, is the largest employer of people and full-time employees across Europe. And it's kind of counterintuitive, because some people think of the large corporates like the largest employer, but in reality, it's really the backbone, and the largest employer is the SME sector across European jurisdictions, responsible for between 40 and sometimes 90% of total employment, and also GDP capital formation.
And there's actually one of the things which, as an entrepreneur, I'm very excited about, is the impact that we help those businesses drive with all their stakeholders on a day-to-day basis. This is real impact you can have with this activity.
Well, I'm curious to know, getting more into the growth path that Novicap has taken. I mean, before we jump into challenges, I'm actually curious, how did you choose Spain as your kind of first target jurisdiction when you were building out?
Good question. So indeed, I started a business in London and then decided to focus on Spain. The original thesis behind that is that Spain has the longest payment terms in the European Union. So if you're a small, medium business and you sell goods or services to the government or to a large corporate, naturally those counterparts have a lot of negotiation power or have certain bureaucracy or inefficiencies to pay you early in the case of the government, and as such that creates an important working capital finance need. So that was the original thesis. Another interesting driver for let's say demand for this sort of working capital finance product is that there's a long-term trend in Spain of bank consolidation. This is across the entire European Union, but I think especially in Spain, the amount of non-bank funding is still relatively small in the mix. If you first look at US markets, I think bank funding is about 60% in the economy. And so 40% is specialty finance, is fintech lending, and so on. In Europe, that is, I think, around 80%. But in Spain, bank funding is more than 90%. And as such, we think there's a long-term trend of banks obviously retrenching now, and this is accelerating in this more recessionary times, but also banks consolidating, and as such also the limits that they have available for SMEs are being decimated. And that is something which we believe is a long-term driver of growth for a business as us.
And as a side question to this, this point is very important about banks, right? A lot of the reason why our sector exists, fintech lending, is due to the fact that banks cared less and less about it over the years, right? And so every other crisis that came about was proving to be an accelerator of this very structural trend. And so we had the global financial crisis at the start of it, when the fintech really was born within Europe, and then you had more recently the pandemic in 2020, now a recessionary, inflationary period, and they all proved to be acceleration. What do you look at when you see a bank? You see a competitor these days, you see sometimes a partner as well, because I know that you also have a bank partnerships. So what do you see when you look at a bank?
We are complementary to banks. So this is a very big difference with perhaps other players in the space. Most of our clients are banked. They have access to credit lines. Now, having dealt with a lot of banks, there's 1,001 reasons to say no. And as such, very often they are not in the position to provide more liquidity, more working capital finance to that business. Most banks then underwrite the borrower. So in this case, the SME, the supplier of those goods and services sold to large corporates. And as such, if you look at on a borrower basis, these are relatively small companies. They seem risky. And the credit limit that banks have available for those is relatively small. And so if you as a business, as an SME, need more access to working capital finance, very often the bank cannot offer it. And Novicap has multiple bank partnerships live. And we actually believe this is one of the origination channels and that is going to accelerate the most in the coming years. As banks are indeed retrenching from that segment, they're starting to be a lot more disciplined when it comes to unit economics, the cost-to-income ratio in that segment. And we see more and more banks putting up the threshold, of assets per SME they finance. That's increasing. And that's really opening up a European market for us. And we, I think, are in a prime position to take advantage of that. And maybe a side note on those bank partnerships. These are obviously performing clients that are being moved to Novicap.
Yeah.
And that gives us a positive selection of risk, which we're really excited about. Very often, to name one relationship we have, the portfolio there that the bank manages has an average, I think, life of 20 years. So the clients have been with the bank for 20 years on average. So the banks have a lot of data on them, and they're very happy, and they want to maintain the client relationship. They just need a partnership with a business like Novicap to provide more liquidity, more working capital finance to these businesses.
So it's long-term relationships with strong sellers. These again, it's not the case where I think in some other sectors of alternative lending where maybe the non-bank lender is the lender of last resort. It sounds like it's very much a function of helping to cover this gap that exists as more and more banks withdraw due to higher capital requirements for lending to SMEs, unrated corporates, versus then taking other exposures on their balance sheet, which is unfortunate. But again, I think it speaks volumes to the positive impact that your firm is having, and of course Fasanara's strategy of supporting SMEs within the European economy has. I think filling that gap, and it's doing so much over such a long period of time. So being around since 2015, I have to say that does make you one of the longest running and operating non-bank lenders, especially in the fintech space, where we kind of saw huge growth in that sector between 2015, 2019. Kind of a lot of lenders pop up, maybe not as focused on credit as you were, and maybe fell out of the picture.
Many were swimming naked, right?
Yeah.
I think that's what we've learned, that there was this irrational exuberance of venture capitalists, private equities investing in this space, and many have lost touch with what really matters. I mean, this is a risk business.
Of course.
And I think myself as an entrepreneur, I've really surrounded myself with fantastic talent to really build out that organization when it comes to risk, operations, collections. And many lenders out there, or especially fintech ones, have in the last few years, with free money, right, and a zero interest rate policy, which we've all seen the effects of that, and with the hangover effect today as well. Many of them didn't have the rigor to run this business at scale, and these are either shutting down or become also M&A opportunities for platforms like us.
Yeah, it's scary to think that in the lending space, some businesses could have started out with risk as an afterthought.
That's right.
And really sourcing
or also adding to that, another common problem we've seen is that there's a legal, regulatory heavy business, and there's no such thing as a innocent cutting of a regulatory or legal corner.
Oh no.
And quite a few fintechs have been caught by that as well.
Because the sector is considered to be unregulated, right? But then when you look deeper into it, there is a lot of regulation, a lot of need for licensing. And so it's the people that they come into this sector thinking of establishing fintechs just for the purpose of being unregulated, and they have an easy way in, they are misjudging.
It's also about building up core functions which are maybe less natural for technology entrepreneurs. Think about compliance, KYC, AML. These are very big topics in our world, and many entrepreneurs are not equipped for that. And I think we've very early on instilled this discipline. I remember setting up KYC, AML compliance myself as an entrepreneur, and going through audits at starting I think in 2016 or so. And we've consistently passed those, and also have really scored brownie points about the technology we've built. Because eventually we're a fintech, and we also believe that technology can help us to address and automate and improve the economics around topics like KYC and AML as well.
Yeah.
Well, that sounds like a great kind of segue into a section we really like to highlight, which is super interesting, not just to kind of investors, but of course to other lenders and people who are interested, entrepreneurs in building out businesses, which is how you've addressed the challenges you've faced in scaling the business to the level it's reached. I think one of the things you already mentioned was establishing the compliance function early, addressing maybe the less sexy parts of the business. Can you dive more into some of the other challenges you had to tackle as you grew up and grew the book exponentially?
One learning which was we learned the hard way is that when I started in 2015, our product we had a single product, receivables factoring, sold to small medium businesses, and very often those businesses were contracting to discount to finance a single receivable, a single invoice.
Yeah.
And what we learned from that is that it typically led to a sort of low repeat, high churn type of customer, which made it really difficult to make money, because if they're high churn, it's hard to recover your acquisition costs to make money on that customer. But then more importantly, it also led to an adverse selection of risk. And then starting, actually when we started collaborating, we changed that product suite, first of all. So we moved towards a multi-product. So we now have 3 credit products. So we have everything receivables finance. It's a bit like when you enter a gelateria, you have many gusti, many tastes, right? Flavors. And that is very much how our product is also built. So we have different levels of recourse, types of collateral we take, we cross-collateralize, and so on and so on. And so we ensure that the products are built in a way, first of all, that the customer, most customer-centric, but also in terms of downside protection. Then we have everything AP, so everything supply chain finance, reverse factoring. And then we now also have a working capital loan, which is a 12-month revolver, secured or unsecured, which we believe gives more flexibility to a certain set of businesses to finance their working capital. So that was the first thing. So we moved more towards a multi-product setup. And then also, very importantly, all our customers today are recurrent. The minimum period over which we contract is 1 year. So we're not the sort of one-off, single invoice factoring company anymore. We're really focusing on long-term relationships with all our clients. And then more lately, we've also added payments products, where we don't finance, but we're leveraging our platform or capabilities in terms of pricing and underwriting to help typically businesses which have access to liquidity, either through banks. They have, for instance, seasonal cash flow, so there's cash on the balance sheet from time to time. We help those optimize their working capital by providing early payment discounts to their suppliers, leveraging their existing credit facilities.
Interesting. And on this point, Fede, how successful was the cross-selling and this move into multi-product? So how many of your clients today, they take more than one of your products?
It depends on the customer segment. So also one of the main differences perhaps with other peers in the space is that because we're multi-product, because we can provide that continuous end-to-end system for working capital management and financing, or clients today are a lot more mid-market in terms of profile. So we've also grown up market in terms of customer size. And those mid-market companies are typically also interested in contracting multiple products. SMEs typically, as you can imagine, they're interested in a credit product. But in the mid-market segment, we see a lot more opportunities also to optimize working capital in a holistic way. And as such, also cross-sell or upsell across that customer base.
I think from a funding perspective, from a lender's perspective, and from the viewpoint of a team that's so focused on the substantiation of a strong, effective underwriting, scoring, and monitoring process for our lenders who we provide funding to. It's great to hear, of course, the relationship perspective from, well, you're going to benefit economically, you're going to recover your costs, but then more than that, the longer you have this relationship, as you highlighted, the more data points you have, the more insight you have into their customer base, the speed of payments. That sounds like a huge USP. And then I think also the point you mentioned about going more towards mid-market with those relationships and that suite of products, we definitely saw it in the evolution of your book. As we see, 35% of your book is borrowers who have turnover, between 5 and 10 million. So you're definitely still serving, the SMEs, but it's great to have that now, that customer base growing and growing of the middle tickets.
Yeah, we also believe that mid-market is an efficient way to market or go to market when it comes to acquiring SMEs. Because as we all know, SMEs are fragmented. Yeah. There's a lot of them in Europe. They're indeed, this is the European economy. Now, if you go through mid-market businesses and you acquire those SMEs through the supply chain, that becomes a very efficient origination channel.
Absolutely, and I think that as a funder, we have seen you really making great progress, remarkable results, also in terms of defaults, in terms of delays. The book is excellent. We have seen the same model, of course, over other countries multiple times, like another 50 times over the course of our past 12 years. And definitely you stand out in terms of quality. So congratulations on that, definitely from the viewpoint of having invested in you for longer. Tell us about your reference market today, Spain in particular. How is that more difficult than in the past? Of course, we are going through a recessionary period, an inflationary period. Tell us also how you look at this period vis-a-vis the pandemic period, and what the differences you can trace and what lessons you have learned.
We're indeed, the state of the global economy is there's a lot of ambiguity around it, right? It's, if you had to pick this emoji in WhatsApp, it will be the I don't know one.
Shrug, yes.
I think that I'm not, you're a lot more experienced in that regard. But just as an entrepreneur, it seems like there's a lot of ambiguity. There's a lot of uncertainty out there. Maybe just first taking the point of inflation. What we really like about working capital finance, and especially receivables and payables, they're short dated. On average, we're looking at a 60, 90-day time frame. So the ability to reprice every 60 or 90 days is very attractive. And this is obviously the polar opposite of, say, term loans, where you are locked in. I mean, maybe you have a base rate that increases, but you're locked in for 5-7 years. And so that short-dated nature of our asset class really allows you to A, reprice, which inflation from that perspective is less of an issue, but also B, and this is, going back to your point of the pandemic, you can divest from certain risks or certain exposures really rapidly. Pandemic was obviously, in hindsight, it was a very strange period for everyone, besides the human loss and drama. I think specifically about our performance, it was, when you look back on it, it's like it's all coming together, right? It's all becoming, in my view, it was someone described it to me recently as it was a bit like, the first time you had sex. You really don't know what's happening, and it's all over before you even realize it. And so I think that's a bit the experience for everyone. But so at the start of the pandemic, everyone thought the world was vanishing. And we were very disciplined in risk. We took advantage of the ability to especially divest from certain exposures. So we really had, and also with our funders like yourself, we had almost daily conversations about certain exposures. And so our risk team there, even though we focus on automation and on automated underwriting, was really working around the clock to make tough decisions when it comes to exposures. And so the short date nature helped a lot there. In fact, the pandemic years, we had a best-in-class performance when it comes to loss rates. Now, what happened afterwards, or during the pandemic, as you know, is the unprecedented monetary and fiscal response. I think about 1/3 of the global GDP entered the economy in record time. And so naturally inflation is one of those hangover effects today. But during that period, what happened was many of our clients were not in need of credit because they had those, government subsidized or guaranteed loans with banks, and that money was free.
Yeah.
And that's when we in fact saw our payments products, which focus on those cash-rich organizations which have access to credit with banks at best-in-class rates, which we're not going to compete with.
Yeah.
That product actually started to accelerate because it's a form of balance sheet arbitrage. I have access to a Santander facility at 0% interest.
Absolutely.
I have a headroom of 3 million. Why don't I use a Novicap platform to pull down that funding from Santander and then push it back into my supply chain at an early payment discount of 12% APR? And that is really, that became our focus during that period.
Yeah, and I remember our conversations during that period, and it was actually much more difficult than today, right? So if I have to compare the pandemic to current recessionary,
right.
inflationary period,
Yeah.
this one is much easier to deal with than back then. Back then, you had, first of all, you had the panic attack of having everything running into a standstill all of a sudden, right? And so that at the time there was the fear that it could have led into sequential failures for a number of corporations, even governments back then, right? Is very different the case nowadays, where we all know what the sources of risk are, and all policymakers are lined up to fight it, but in a way in which it doesn't break, let's say, the glass house. And also back then, you had a lot more competition than you have today. Actually, today you have less than a month ago and a year ago. Back then, you had the competitions from the banks with the government guarantees at much lower interest rates, because the pandemic had led rates down to zero and negative, and close to zero even in the US. So you had the banks competing at much lower base, much tighter spreads, and with a government guarantee, and it was kind of an unbeatable competitor.
It was just, the market was flush with liquidity, and this obviously led to some of the irrational exuberance bonanza in venture investing, as everyone had access to record amounts of funding. But during that time, indeed, many of our clients, which again we have long-term relationships with, long-term contracts with the credit products, they the utilization of those products was decreasing because they had access to financing.
Well, I have to say, in that response, I have to highlight a couple things that I heard that this just are music to my ears from someone who was screening opportunities all day. Hearing the dynamic response in pricing in relation to risk. The ability to take advantage of short durations to then actually effectuate risk-based pricing, which in the current economy, being able to price up. The agility that you demonstrated within the business of really back in the pandemic time, GICS is available in Spain, and you say, okay, what is the new product we can develop to then still service these relationships, because we got them on board, we like what we see, we want to keep them through this time. We know that the government support will eventually recede. It has. You still have those clients, and you're growing the facilities with them. So that those two things, the agility, finding the new ways to serve the customer base that you had to keep them, and then of course the dynamic approach to pricing and really understanding the importance of risk-based pricing. These are huge wins, I'd say, and USPs from a lender perspective. I think you spoke briefly to kind of current market being of course very unique, and kind of we're all in this ambiguous state right now of weekly changes in market response to rates and new developments. But I have to ask if you could highlight maybe just one challenge that you see for the future, or kind of immediate term, next 6 months. What is this one challenge that you see that you're thinking about how to solve it, and that is your most immediate focus, if you had to pick one?
So again, because of the ambiguity in the market, we are currently very risk focused. We're excited as entrepreneurs about the unprecedented demand we're seeing. So I think where maybe in the last few years, and then also accelerated by the pandemic, we came out the QE, ECB's QE programs. Then we had the pandemic with another record amount of liquidity injected into the economy. From many perspectives, these were the worst times as a fintech lender because banks were providing a lot of liquidity. That has completely changed. And so as entrepreneurs, we're very excited about the origination capabilities we've built up, and we're excited about growing much faster. However, we have to balance that with risk discipline, because we also know that lenders like yourself, funding providers, will be taking a close look at our 2020 vintage and this year's vintage, because indeed the economy is changing, the global macro is changing. And so balancing that ambition to grow with taking a risk-first approach is probably one of the hardest bits to manage this sort of fintech lending operation. Now, I do think that there we have built up a fantastic management team, which both has decades of strong origination commercial experience, and then also the risk expertise throughout cycles.
Yeah.
And that is really the dynamic that I see in play in my management team, is that they're balancing each other very well. They're questioning and challenging each other, but also ensuring to think long term.
Yeah, and I think on the bright side, going through difficult times also means going through validation point, right? Because fintech is still a nascent, early asset class, fintech lending, especially in the eyes of large institutional allocators, which are the ones that they fund Fasanara, for example. And it's useful to go through a pandemic. It's useful to go through a recessionary, inflationary period. In the meantime, the asset class becomes bigger and bigger and validates itself in the eyes of those allocators and represent more and more of an allocatable asset class for the future. Fede, if you have to name one single biggest achievement for yourself and for Novicap together, what would you pick up? What would you want to highlight?
I mean, for myself personally, I think I was very virgin when I entered this market. Now more than 7 years ago, and well, I've built up the organization from the internet up. Right? Everything we've built is proprietary. You see a lot of lenders out there, or even fintechs, that eventually, when you scratch a little bit, they're doing things in Excel. Their underwriting model is very much an Excel model, or they have different systems. They don't have a single source of truth like we have. So we've really built up that platform from the internet up. And I think as a technology entrepreneur, it was a difficult start. Again, I've grown more comfortable sharing that nowadays. But I definitely was quite virgin back then when I started. And so I think from that perspective, on a personal side, I've built and surrounded myself with a fantastic management team. Patient investors, which is also very important. This is not a quick win scheme where you pump and dump a business, which again goes back to risk discipline and thinking long term. And then on Novicap's side, I think it's exciting again to have provided working capital finance optimization for thousands of businesses. And I think the impact there that we're driving for all those SME stakeholders is fantastic. We're helping them to make their payroll, to pay their taxes, their VAT. I mean, many of these businesses have a monthly expense, but they're getting paid in 6 months, and the ability to bridge that to drive impact, I think is a fantastic. That feels fantastic. It's a real economy. Sure it's not some speculative.
It's very tangible.
It's very tangible.
And in days like this, where there is a lot of over financialization of public traded markets, like both equities and bonds, at days like this in which there is a lot of volatility, excess volatility, I think that in bond volatility at some point over the course of the last 12 months was higher than equity volatility. Yeah. Earlier on this year, you had 3 days with the 3 sigma events on short-dated rates, 3 days in a row. So something like never witnessed before. So at times in which things are so quirky and messy, chaotic, it's great to have a tangible effect on people,
This
companies.
is a non-speculative asset class.
Yeah.
We are financing real companies with invoices for rendered services or delivered goods.
Yeah.
There's no speculation around that.
Yeah, and you're at the end of the day, a lot of the statistical probability that someone watching this video, if they are in Spain, the Netherlands, or UK, had their payroll paid because their firm factored invoices with you is actually quite high. And so, that to me brings kind of us kind of towards the end of our discussion here of, I think we've talked a lot about the development path, the challenges you face, the insights into the market. I do think we have maybe forgotten a little bit that you do operate in the Netherlands and UK. And so I'd be very curious to hear from you what you see in the next 12 months for Novicap and in the next 5 years as kind of primary goals. And maybe if that does involve growth in some of these countries or more expansion, I'd love to hear it.
So in the short term, we are excited to build out that leadership position in indeed the Netherlands and in Spain, where quite soon we'll have 1% of the annual factoring volume. Right, so banks also are starting to pay attention to that. They're keen to develop those partnerships with us, which again they lead to origination volumes, but also this positive selection of risk. So that is really the immediate short-term goal of the organization. In the longer term, we believe that completing that end-to-end suite of credit and payments SaaS products is going to be very exciting. So there's a number of products there we can add. This can happen organically, can happen inorganically, and I think also I would expect the organization to expand geographically. This is not because we see a lack of demand in our home markets, where actually we believe we can keep high growth up because again volumes are large, and also that bank retrenchment is offering other opportunities. We do believe that geographically there is a case to be made to expand in other geographies as well. So that's something we'll be exploring. And I think then as we touched on during this conversation, the risk discipline remains key in our organization, as we need to make sure the raw materials for the credit product are satisfied with our performance.
Fede, how do you pick up countries to expand into? What is the thinking process there? Also because a lot of fintechs failed at the geographical expansion, international expansion, multiple times, right? So there are very rare examples of successful win cases in the market. We have seen people from the UK moving into Germany, Spain, and then retrenching. We've seen people from Germany trying to invade certain markets in Southern Europe and retrenching. We've seen people from Southern Europe, from Italy, for example, expanding in France and then stepping back. So what is your thinking process?
Yeah. I think there's no right way. There's multiple ways you could approach that. We will typically, more than most of our origination revenue and on a logo basis comes through partnerships. And as such, we believe those partnerships are a very efficient way to jumpstart a new market. And so this can go back to bank relationships. This can go back to some of the professional advisors we work with. And at the same time, as you can imagine, because of the network, the business network we've built up on the Novicap platform, while indeed we are focused on the Netherlands and Spain today, we are a lot more geographically diversified when it comes to the supplier base. So this would also potentially be a way for us to prioritize certain markets. So to answer your question, I'd be looking at that more from an origination perspective, either through partnership or existing supplier network, and jumpstarting a market that way.
Perfect. I think we are at the close of it. I don't know, Matt, if you have a last question for Fede.
A curveball.
No,
Difficult one. A difficult one.
No, I wouldn't say curveballs. I would just, say to close out, I think you know, I really appreciate the insight you've provided into your growth path. Again, the markets. Maybe if there's one last one just for fun, I'd say, what do you see the Euribor ending the year at?
Well, I'm definitely
Say.
not the best position to answer
Over
that
under
one.
on 3.5.
I would expect it to be over.
Okay. There we go.
Okay, Fede, thank you also for the Nostradamus moment.
Yes, exactly.
And thank you for being such a great partner over so many years.
Yeah.
We look forward to continue the partnership. Thank you for coming and sharing your experience. And I hope viewers and listeners will enjoy this. I'm sure they will, because it was very informative. And see you soon.
Perfect.
So much.
Thank you so much for the long-term relationship and the trust you also put in us as a scale up. And I look forward to the coming years in which we can achieve the next level of success.
To the next billion.
That's right, which should accelerate much quicker now.
Great. Thank you.
Thank you.